Coming up, Australia's unemployment rate unexpectedly falls, so now we're on inflation watch to see what the Reserve Bank will do with interest rates. As a result, the share market falls. The details next. Your daily 10-minute business and finance news wrap for this Thursday, the 19th of October 2023. We'll speak with Angus Geddes from Fat Profits for the latest on the share market, including reaction to today's lead finance story, which is the unemployment rate, which the ABS says fell from 3.7% to 3.6% in September. That is better than expected. While some say it adds to the case for a rate rise, there is some softness in the data. So for all of that, I spoke with Oster, the chief economist at NAB. Alan, based on these numbers today, how would you describe the jobs market at the moment, and what does it say about the economy?
The jobs market is still very strong, basically, is the bottom line. So, employment didn't grow much, and the par rate fell a little bit, but that's off a record high. And so an unemployment rate around 3.5, 3.6, depending on how you round it, is still really good. And so it says that for whatever reason, yes, the economy is slowing, but people or businesses are still reluctant to fire people because they're too hard to get. And so I think it's a pretty good economy at present still.
Still, though, looking through the numbers, there are some weak points, no? For example, the fact that it's part-time jobs driving the gains, does it suggest that we are seeing this slowdown in economic conditions?
Oh, I think economic conditions have come down significantly compared to where they were. You see that in the national accounts, and you see that particularly in retail. But I'd sort of wouldn't put too much weight on full-time versus part-time. Hours worked were also slightly down a bit in the month. But big picture is the labour market's still pretty good, and that's the way the Reserve Bank would look at it.
Okay. Speaking of the Reserve Bank, one of the things it kept talking about over the past year, I guess, is this fear of a prices or wages spiral, right? Yep. Is there any evidence in these numbers that could come to fruition?
My short answer is no. What we've seen is very strong labour market. We've seen wages pick up to around 4%, but one of the things we're starting to see in our business surveys is that yes, they went up a lot around the time of the national wage case. By the time you get to September, and then you look at expectations, you also see that businesses are saying, well, that was a bump and it's through the other side now.
Speaking of businesses, you also released your quarterly business survey today. We know that the RBA's seeming to lose patience with the slowdown in inflation. What does your quarterly business survey say about cost pressures in the sector?
Well, you have to be careful because it's a quarterly number. What it's saying is cost pressures went up, in particular associated with these wage numbers, and that essentially, if you look at the prices series, essentially it's like 1.1 in the quarter for effectively a trim mean, which would be higher than what the Reserve is looking for. At the end of the day, though, what you probably say is this has been significantly affected by what happened in July and August. And then we look at and even in the survey, we say, where do you expect to see wages in the next 3 and 12 months? They're down relative to where they are now. So I think it's sort of a temporary thing, but obviously needs to be watched.
So ultimately, we're waiting for the next Reserve Bank board meeting on Melbourne Cup Day. You've already put on the record that you're expecting a rate rise to 4.35%. Yep. When you look at the data we saw today, the jobs data, how does this all support your case and why?
It basically says the labour market's fine, and therefore, if you look through it and says the economy, yes, it's slowing, but it's not awful. And then you put your focus back onto inflation. And ultimately, the next week's third quarter CPI is critical. So they look at what's called the trim mean, and we're talking about 1.1. Reserve has got basically a starting point of 0.9. So if you've got a situation where services are sticky, the labour market's strong, wages going up a bit, you may well find that the Reserve Bank's new forecast has inflation not coming back down into the band until the end of 25 or early 26, and they've got no patience for that. So that's why I think I think it's a line ball. If you get a surprise on the downside in the trim mean in the CPI, they'll sit and watch. But I think more likely on our expectations, they'll probably do 25.
Final question. At what point do you think higher rates could trigger an extreme slowdown or a recession? For example, there's been a lot of talk about rates already being at the peak. I guess as a result of that, some consumers may already be factoring that in their minds to think another rate rise is on the card. What will it mean for them?
Well, an extra 25 point doesn't make a lot, but it does probably change the psychology. And I think what we're seeing, and we'll also put out a consumer sentiment sort of survey today. Sure, cost of living is still the number one thing out there, but for the first time for 7 quarters, the cost of living index went down a touch. So maybe people are getting to live with it, and they're saying, right, I can get a second job, or I can cut some of my consumption. And as long as rates sort of start to come down in 12 months' time, I can juggle it.
So you're really sounding optimistic then about the economy. Is that right? People are doing fine, in other words, generally.
No, I think what you've got is the economy is doing better more resilient than what we expected. But consumption's 55% of the economy is pretty awful, and particularly retail. And so people are saying, I'm not going to spend if I've got any discretion. Now, what's discretionary? It's in your eyes of the beholder. So Taylor Swift is not discretionary, apparently. But, buying mince rather than I fillet is probably discretionary. And so I think, those things are important. So the economy is still very slow, and consumption, if you look at consumption per capita looks awful. And it's really only more people joining the country and spending a little bit more that's keeping in consumption at positive. And in retail, it's negative, even with that. So, yes, it's a tough world, but I think you might just get through without a major recession.
So in other words, what you're saying is that people are adjusting their habits to this slowdown.
Yes, that's right. And, if the labour market stays strong, ultimately they can do it. And let's say they're talking about a 12-month window where rate cuts will then start to help things as well. So it's manageable, provided the labour market stays strong.
I've got one more because you've triggered one more idea in my head, though.
Okay, go for
it. Didn't the RBA, though, seem to suggest it needs the unemployment rate to rise to 4.5% to be at that neutral level on inflation?
What it's basically saying is that you need a higher level of unemployment, otherwise wages will get away from you. Now, it doesn't mean necessarily that there's going to be a lot of job cuts. Rather, and you've seen it a bit today in the data, you don't get much growth of employment. And if you've got a lot of extra people coming in, it means there are not going to be as many jobs to fill that sort of increased labour force. And so that's where the unemployment rate rises, not because they're firing everybody.
Alan Oster there, the Chief Economist at NAB.
Now, Market Day on the SBS On the Money podcast.
So talk of higher interest rates pushed our share market down. The S&P ASX 200 down 1.4%. I spoke with Angus Geddes from Fat Profits for more. Angus, the ASX seeing a bit of a tumble today. Why?
I think there was a bit of a bad reaction to the unemployment numbers, which came in higher than expected at 3.7%. I think the unemployment rate was. So obviously the markets are a little bit worried that we could see some more pressure on the RBA to tighten rates to cool the economy down.
There's also some concerns around those rising geopolitical tensions, namely from the Middle East, impacting the market. To what extent is it impacting the market? And is it something that really worries you?
Look, I think, without doubt, it's probably the worst geopolitical incident we've seen in quite a few decades. And no one really knows at this stage how it's all going to unfold. But I do think, there's going to be implications for the energy markets. We've seen the oil price lift towards $90 a barrel. Of course, that could be inflationary and keep pressure on the central banks to hold rates higher for longer.
You also noted in your note today released to clients that gold is outperforming some local currencies. I think it even hit a record high against the Australian dollar earlier in the week. Are there any opportunities there?
Look, I think, for the Australian gold stocks, there's a lot of opportunity at the moment with that Australian spot gold price closing in on $3,100 an ounce. And of course, a lot of the ASX gold stocks are still well down on their 2021 highs. So, a lot of them are making a lot of, quite decent amounts of free cash flow at current spot prices.
And the Chinese GDP yesterday came out stronger than expected. Do you see it as a turning point for the country?
I think we're getting closer to a turning point in the stock market. And the better than expected GDP number, it's going to really underpin that market. And of course, what we've seen in the last couple of months, and indeed this year, is the Chinese and Hong Kong stock markets really underperform, which, we might see a floor being found fairly soon.
Can I ask you one question just to wrap everything up? And I know there might be different ways to answer this. What would you say is the number one concern for investors at the moment? Is it the conflict in the Middle East? Is it still the potential for higher interest rates to stay longer? Because I know ultimately one feeds through to the other if it's inflationary, right?
I think the main concern at the moment really is the fact that we've seen this meltdown in the bond market, which has put a lot of upward pressure on bond yields in the United States and around the world. And in turn, we're seeing those higher rates, which is doing a lot of the work for the central banks, but, pressuring stock market valuations and really leading to a tightening of financial conditions, which at some point, could tip the economy over the edge.
Angus Geddes there from Fat Profits. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.